As the previous video explained in detail, changes in the real interest rate are going to generate both substitution and income effects. The substitution effects come about because the real interest rate is the relative price of goods today in terms of goods in the future. And the income effect comes about because changes in the real interest rate affect the present value of income, or to word it differently, affects wealth. Before we get into the theory of how changes in real interest rates affect consumers' decision about consumption versus savings, let's look a little bit at the data. And two facts are going to come out. One is that real interest rates, as measured in the data, move around a lot and can even be negative. And the second point is that this holds true whether you're looking at very short-term interest rates or longer-term interest rates. There are two different measures of a short-term interest rate. And short-term means in this context that it's 1 quarter. These are 1 quarter interest rates. Now, how are we computing this? Well, the real interest rate in quarter T is just equal to the nominal interest rate in quarter T minus the inflation rate between T and T plus 1. Now, in fact, we really want to have an expectation up here, but the way I've computed these, it's what's called an ex post real rate. And so what I have done is use the actual inflation rate. And I use two different measures of inflation. The blue line uses the consumer price index, and the red line uses the GDP deflator. And the story told by these two different measures is largely the same. There are some differences, but the general story is that let's see, I would say that if you look at this and eyeball it, the mean or the average in real interest rate ex post is maybe 2 to 3%, but the real interest rate has varied a lot. So in the late 40s and early 50s, we had very volatile inflation. And during that period, so remember, volatile inflation is going to show up as this thing jumping around a lot. And what we saw was some periods of very negative, strongly negative real interest rates. How did that happen? Well, inflation turned out to be much higher than people had expected or had built into their calculations when they determined what nominal rate they would be willing to lend at. And then we have some more negative periods in the late 50s, and then it sort of hovered around what I think is essentially the mean. But then during the 70s, which was another period of high and volatile inflation, we had negative interest rates again. Then in the 80s, the early to mid 80s, this was when Paul Volcker became chair of the Fed, and his job at the time was to try to get rid of the inflation that we just talked about in the 70s. And he kept interest rates extremely high, and that kept real interest rates extremely high. And so you can see that during this period, interest rates are clearly well above normal. And then they just kind of hovered around in the normal range for quite a while. And then in the early 2000s, and again, most recently, there has been a lot of volatility in these real interest rates. And as we talked about in class, in recent years, this real rate has been negative. Now, if we look at longer term real yield, and this is also a longer time series, it goes back to 1919. Let's say that this is 10 years. So we have 10-year bonds. And the way that this is getting calculated is that the real interest rate today on converted to quarters, so for 40 quarters, is equal to the nominal interest rate on those 10-year bonds minus what people are expecting of inflation between period T and T plus 40. And here they're not just using the actual inflation rate over the term of the bond, they're using some model derived inflation rate. And what you can see here is that in general, real interest rates, long-term real interest rates, that's what these would be, have also fluctuated quite a bit. They tend not to be negative, and they tend on average to be higher than those 1/4 real interest rates that we were talking about. But nonetheless, the pattern is largely similar, and that is that in the 70s, we had interest rates, real long-term interest rates that were low by historical standards, just as they have been low by historical standards during the financial crisis. Then they started to rise, and during the Volcker era, long-term real interest rates were higher than normal, and then they've sort of gradually fell until they became very low during this crisis. So what you want to take away from these pictures is that real interest rates, whether measured at short horizons or long horizons, are quite volatile, and therefore, as our theory will suggest, they should induce important changes in economic behavior.